Welcome back, class. As promised at the end of last lecture, I wanted to start off by talking a little bit about the derivative software that's provided by the textbook. Um, when you go to the author's website, you can download it there. There's a link for it in the syllabus, which takes you to John Hull's website. And basically, it's just an Excel document, and you'll open a file called, DG400A. And the file of all these tabs that we're going to spend the most of our time in is not the first one, but which is where the title is, but the one that's underlying labeled equity, FX, index, futures, options, calculations. Okay. Um, so it's pretty simple to use this. You just kind of toggle a couple things here. So in the example that we went through last time, we're looking at equities, right? And let's just assume some stock price. I think in our example, the share price started at $20 on the call option. I think we didn't necessarily have an assumed volatility here, but we don't need that because this is an option binomial option pricing model. Let's say the risk rate's 4.5%. That's roughly where it is these days. Let's do a drop down type for a binomial European style option. Let's say it's got 1 year life, and let's say like the example we had on that call option was $21. Um, and the derivative gem software here can handle up to 500 tree steps in terms of the calculation. So 500 being the most it can do, which will give you the most precise value of the call option, and it'll just work through time. And when you hit the calculate button, sorry, I'm gonna give it some volatility. Um, let's see. Let's just say it's normal volatility of an underlying stock because it has to use the Cox-Ross-Rubinstein formula to calculate the U and the D by using the underlying share volatility. So just as a reminder, remember that U and D had, an empirical probability that looks something like this, right? So that's why it needs this volatility value, as it were. And so when I hit calculate button, it gives me a value in this case of $1.56, right? And that's what you see down here in terms of the price. It also calculates other Greeks for you. The one that we've already talked about is delta. So at this point in time, the delta is 0.532, as you'll see here. Now, when you want the machinery here, right, derivative to show you the tree, you can hit display tree, but unfortunately it can only display 10 steps of the tree because 500 steps is quite larger than you may think it is. But essentially it's showing you 10 the tree as if it had only 10 steps, right? So said differently, calculate and display the tree. It's the same thing here. And so this is all the different paths of the share price on the top, and then of course the terminal value of the option in the bottom part here, just like we did in the last example, the last lecture, as it were. Okay. Um, so we'll come back to this because I want to jump in and talk about the next lecture, which is the Black-Scholes Merton option pricing model here. And let me go ahead and share my screen for you. There we go. Okay, so in this lecture here, we are going to, move from the binomial tree into continuous time Black-Scholes-Merton model. And the flow is basically to motivate the continuous time setup. And then this will set up the log normal property. We'll talk about the log normal property of stock prices, and basically it's just not log normal properties at large. And then we'll derive formulas, and then take a look at the implied volatility and a few practically important extensions here, um, um, using the Black-Scholes model here. So by the end, we'll be comfortable pricing European option with the Black-Scholes-Merton formula and explain what implied volatility is to a a layman, as it were, a non-specialist. So we'll define all these things. This is our path. Okay. So how do we get from the binomial tree to the log normal distribution? Well, remember the binomial tree was our first option pricing tool. And as we let the number of periods grow larger with smaller and smaller steps, the discrete two-state outcomes kind of smear into a right skewed distribution of stock prices. So if you take a look at these histograms, each one of these is showing the same construction here, where we have U equal to 1.1, we've got D equal to 0.95, we have a risk neutral probability of an up move of 0.5, okay? And we're starting with a share price of 100. So each one of them shows the same thing, except when we make delta T really small. So as you see, when we have four periods, right, which means delta T is relatively large, you only have like five spikes here. At n equal to 10 periods within the same big T, right, you can start to see that a bell shape starts to form here in terms of the stock prices. And then, of course, as we get to 20 or more, you can see this log normal distribution starting to show up, right? And so a key point here is that the log normal distribution is not imposed just for analytical convenience. It falls out of the multiplicative random walk in the limit. So, right, this is this Brownian motion that we are talking about at the end of last lecture. So one question you might have is, why is this, right skewed? And so I'm going to draw a little curve over the top of this thing the best I can, right? So it looks, like this, right? It's right skewed. Why is it not, kind of normal, as it were, as we're kind of used to saying the normal distribution? Well, the reason for this is that stock prices, right? This is the distribution of stock prices. The stock prices are bounded to the left by the value of zero. The stock price cannot go below zero, as you probably well know. Um, so um, it's bounded to the left-hand side, right? They're bounded below zero, and so the multiplicative process can't be symmetric, right? Gains will compound on top of gains, but losses can never push prices negative, right? You can't have a negative 100 more than negative 100, no matter what price you're starting from. And so the Black-Scholes-Merton approach is a closed form pricing formula that utilizes this time being at the continuous time limit. Okay, that is delta t is infinitesimally small. All right, let's talk about some assumptions here. Okay, so generally speaking, I'm just going to kind of walk you through the intuition here that the Black-Scholes random walk assumption, at least over a short period of time, the change in the share price, right, um, is roughly normally distributed, and it's normally distributed with an expected return of mu times the time step, right? So over a few seconds, minutes, even a day, right? It's going to be distributed with a mean expected return of mu delta t, and the variance of that return is going to be sigma squared, of course, which is variance times delta t, the time step, right? They're all just scaled. And so it's, roughly normally distributed, right? And there's two things to think about here, though. While we're setting this up as, mu being present, mu is not going to turn out to appear in the pricing formula, right? Because that's that risk neutral insight. And the other thing to take into account here is that as we scale volatility, then volatility was scaled with the square root of time, which is why we tend to write, sigma square root delta t for standard deviation, right? That is, we would scale over time by, sigma delta t. I'm sorry, sigma times the square root of delta t. So this kind of gets us into, so over sort of, small time increments here, the stock returns are roughly normally distributed. But as we get, further in, right, the prices, as we compound through continuous time, we approach a log normal distribution, right? And so the intuition comes from how prices evolve, right? Number one, prices do not add up together, right? They multiply, right? So, for example, a 10% gain followed by a 10% loss actually leaves you below where you started from, not back at where you began, right? At par. So, said differently, right? The share price in the future is equal to the share price today times some random growth factor, whatever it is, up 10% times, down 10%, and so on. Um, and so the multiplication of random factors corresponds to the addition of their logs. So this is, just log normal math, right? Um, when we take the logs of the share price, then we can just add the logs of the share prices across many different small logged returns. And once we're adding many small independent random terms, then the central limit theorem kicks in and the sum becomes approximately normal. That is the natural log of these prices. And so the sum, right, is equal to the natural log of ST, which is normal. So therefore, it means that the share price itself is distributed log normally, just like we saw in the prior slide, right? And again, this assumption falls right out of the math. It's not done for analytical convenience here. Okay, so if that's the case, then how is well, again, the share price is log normally distributed, which means the natural log of the share price is normally distributed, and it's normally distributed with a mean expected return, right? Basically, the log of the starting share price plus the movement, as it were, of the expected increase or decrease in the price, right? So this note here, basically, this idea that another way to think about it is we're starting from some point here today, S0, and we know that the natural log of these price is going to be whatever it is to start with, plus some increase or decrease, or some value mu. And I'm going to use mu here. All right. But it is augmented by 1/2 of the variance, you know. And this is actually a drift correction. This is, what's called the Ito correction. So for those of you who are interested, you can go back and read chapter 14 of the text, which actually derives explicitly through Taylor series expansions and through something called the Wiener process. This is the Ito correction and corresponds basically to the gap between arithmetic mean returns and geometric mean returns, which we'll talk about in a few more slides here. And so it's going to be scaled, of course, by the time under investment here. So that's sort of the expected mean return, right? The mean, of course, being the log normally distributed, and of course, the variance is scaled by t. That is to say that the natural log of the share price, its expected variance is, sigma squared t. Okay. Now, what are some of the properties of our log normal distribution here? Now, the log normal distribution has two properties that matter here. One is that it's bounded below by 0, so there's no negative, right? There's no negative stock prices, and two, it's going to be right skewed. That is, the upside tail is fatter, if you will, than the downside tail. Now, the expected price is going to grow at a simple rate of mu, right? As you see in this first bullet point here, the expected share price is equal to the current share price that's going to be drifting up by some expected value mu. But the median price itself grows at mu minus the half of the variance, which is the same correction as we saw before, right? That is, this here, the median itself, is growing at a different rate than the mean expected return. So the variance expression itself is going to look a bit ugly here, as you see, right? But its key feature here is that it grows with sigma squared, right? You can see that here in these um, bracketed expression here, which basically says that high volatility stocks have very fat upper tails. um, um, Basically, it increases the probability. The higher the volatility, the increased probability that I'll end up with a high value as opposed to a low value, at least relative to normal distribution assumptions, right? Um, Now, the expected return, as I mentioned before, in terms of the mean return, um, there's a difference between arithmetic and geometric. This is our variance drag, and basically why realized compounding underperforms the mean expected return, right? Right? This is our mean expected return, but it compounds with some drag because of the volatility here. Another way to think about it is this is what we expected to happen. This is what actually happens to our bank account, the difference between arithmetic and geometric. Now, this gap is half of the variance. And the idea here is that the higher the volatility in the share price, the larger the gap between the expected and then the realized growth. Okay, this is our volatility drag, if you will. Um, and so this is why a portfolio with a very high volatility can have a positive expected return, but still end below where it started, right? So this is important. So let's do a worked example here on mutual fund returns. Here you'll notice here we got years 1 through 5 with different returns. And these are pretty big returns in wildly different directions, starting very positive the first 3 years with a big negative drawdown in year 4, another big positive increase in year 5. Now, when you calculate the arithmetic mean of this, which is the expected return in any given one of these years, you get a value of 14%. But when you compound these returns, right, which is just the gross returns multiplied times each other, 1 plus 15%, 1 plus 20%, and so on, and you annualize them, right? That's what we're doing here. You get a geometric mean of 12.4%, and we can calculate what the drag of the variance is here, basically 1.6%. So this is an empirical, showing of what the drift correction really is all about. That's, the variance, half the variance. And the reason we do this is because investors care about the geometric mean. That's going to compound in their account. That's what's going to show up as far as their ending balance there. Okay. Now, the standard deviation, or vol, as we often call it, volatility, is going to be just the continuously compounded return over 1 year. That's going to be the standard deviation for that. And it scales, as I mentioned before, with the square root of delta t. That is the square root of time scaling. Now, one thing to keep in mind is that this volatility measure is measured in trading days, not necessarily calendar days, because markets, of course, don't trade continuously. They close on the weekends or on evenings, and overnight volatility is much lower than daytime volatility because there's not much trading in most of these markets. So the convention, therefore, is that we have 252 trading days a year. So in the case for a monthly, right, 30 calendar days is something like 22 trading days. So sort of a monthly value for T would be, 0.0873. Okay. So here's a worked example. If you wanted to convert a annual volatility into a daily volatility, you just multiply the annual volatility, right, times, I'm sorry, you just take the daily volatility and scale it up to create an annual volatility number, right? So if, for example, you were trying to solve for the daily volatility, and you knew the annual volatility, let's say it was 0.25, right? 25% annual vol. Well, this is equivalent to a daily volatility of 1.57%. And so, just to give you a sense for that, The historic S&P annual volatility was in the range of 16%. It's been more like 20-ish% since COVID, but roughly 1 to 1.5% per day. Okay, so that's within the ballpark. So how do we estimate volatility from the historic data? Well, I mean, it's pretty straightforward, right? We take observations of stock price over time, over some interval of T years, as it were. I guess we're using tau here, but so for example, if we have weekly data, we'll have like closing prices at the beginning of January 1, if you will, or more precisely, if we start at the end of the prior year, closing day of the prior year, we'll basically take the closing price of the stock price every Friday. So our intervals would be, 1 over 52. Or conversely, because there's 52 weeks in the year. Conversely, if you're doing daily data, it'd be 1 over 252 trading days. Then we would compute the continuously compounded return for each interval. Meaning, right, you have a share price, the time you bought it, for example, and the share price a week from now. And so what's nice about log linear or log normally distributed stock prices is that we can just use the log of prices to determine what our actual return is. So we're going to calculate our return. Here we're going to call it U of time period I, which is basically saying, what was the share price, one period ago? Let's say it's 1 day. Okay. So the share price for my stock I 1 day ago, and what is the share price today? It's basically just the ratio of those two. If you take the natural log of that whole thing, this, by the way, is equivalent, right, to saying, what is the gross return or 1 plus R of my stock I, right? It's equivalent to that same intuition, the natural log here of the ratio of share prices. Technically, it's the natural log of this, right? These are equal. And so in our third step here, we'll just take the sample standard deviation of the share price. We're going to use the the sample standard deviation. We're going to use S here as opposed to sigma, which is typical in probability and statistics. And this, of course, would be our weekly return that we just calculated on the prior step. And then we can annualize it by taking, if it's daily returns, we're going to have, daily mu I, UIs here. And then we'll have the sample standard deviation based on daily information. And then we just scale it by the square root of our time step, delta t here, or tau. We're using it tau now, but it's equivalent to delta t, right? So just think of these as like delta t's from the prior lectures, okay? All right. So with a lot of hand waving, we're going to jump right into the Black-Scholes formulas. Again, the Black-Scholes formulas are something you're going to need to recognize when you see them, right? You won't necessarily have to memorize them, of course, because we'll have formula sheets and whatnot. But in terms of calculating the call price, it's pretty straightforward. It is the share price times N of D1. We'll talk about that in a minute. Minus the present value of the strike price times N of D2. Okay. And the put price has a similar look. You're just flipping the share price versus the strike price. And so now I have to address, this N of D1 and N of D2. So you can actually see it down here in my notes that N of any number, right? D1, D2, whatever the number is. And so there's a little dot here. So N of some number is just the standard normal cumulative density function, right? So back from your probability days, it's the cumulative probability of observing some value, right? Up to that point. And I'll do this a little bit more in the next slide as well. In terms of actually calculating the value at D1, it's this formula, right? So it's the natural log of the ratio of the share price to the strike price plus the risk-free rate plus half the variance scaled by T all over the square root of delta sigma times the square root of t, big T. And then D2 here is just D1 minus the sigma times the square root of T. Okay. So these D1s and D2s obviously get calculated first before you plug them into these formulas. But before you plug them into the formulas, we have to evaluate them. So that n of x function, in our case, it's n of D1 and n of D2. Again, it's just a standard normal cumulative density function. And and it's the single piece of statistics that the Black-Scholes-Merton model requires. Okay, so definitionally, n of x is the probability, right, of of the standard normal the probability of drawing a number that lies below some value x. Okay, so let me draw you a picture here. All right, assume this is the standard normal distribution, right? So standard normal distribution have a mean, right? And of course, there's going to be some standard deviations around that mean. And so if I have some value x, right? And I say, okay, well, what is the probability of observing all the numbers up to this point based upon random draws? Well, when I look it up in our old school stats table, n of x, well, n of x is just the probability, the cumulative probability of drawing a number from this. Basically, remember this whole shaded region you might remember from your stats class. And that's what n of x gives you. So in our little examples, I mean, we don't have x. I mean, we're just actually using this number d1 and d2, right? So n of d1. So I calculate some value of d1. I look it up in those old z-stat tables from our stats class, which we'll do for our exams as well. And we come up with some value. Okay. All right, and when we look up n of x, it's going to range from 0 to 1. So in your typical standard normal distribution table that's been scaled by the standard deviation, your mu, you're going to have a standard deviation of, a mean of 1, standard deviation of 0, uh, mean 0, standard deviation of 1, right, which is a scaled normal distribution here. And that's what you see in these data here. Basically, anything below 0, infinity here, way out here on the tail, it's going to have a 0 probability because there won't be any random draws way down here. If you're drawing from all of this region, of course, well, then the whole probability space is equal to 1. And then, of course, somewhere in the middle, the probability of observing, because it's a balanced, right, distribution, anything left of the mean, right, mu equal to 0, is equal to 0.5. Okay, that's the probability of observing a number below that line. In terms of computing it, I told you we'll use some statistics tables. In Excel these days, you can use these two different functions. Both of them work still. The more recent ones use this norm.s.dist. And inside your arguments, x is equal to whatever value you're trying to look up. So D1, whatever you calculate for D1, you put it in there. And then your other function, your logic functions are going to be equal to true. True basically is telling it, give me the full cumulative probabilities of drawing a number that's equal to or less than, right? This, equal to or less than this number. Okay. Now, let's talk about the elephant in the room here. You'll notice again that those formulas that we showed for the Black-Scholes-Merton models of 2 slides ago, there's no mu. We call it drift in Brownian motion, but there's no expected return. It doesn't enter the option price. Well, why? Well, because the option can be hedged. We can hedge it dynamically using a combination of the stock and the bond, right? Because of put call parity conditions. So the risk preferences of investors just doesn't matter for the pricing here. Only the risk-free rate, the volatility, and the current stock price. So just like binomial option pricing, This is risk neutral valuation. We price the option as if the real world were risk neutral, and the expected return on every asset is R, right? The risk-free rate, right? That's the takeaway. So mu here, the expected return, the drift is irrelevant. And in fact, this insight is what won Merton and Scholes the Nobel Prize for economics. Why did Fisher Black not win it? Well, unfortunately, the Nobel Prize cannot be awarded posthumously. He died a year before they awarded this Nobel Prize. Let's look at an example then, using all of our machinery here. Okay. Here's our setup. Input share price today is 100, strike price 95, risk rate's 10%, 3 months to maturity, and our volatility is high at 50%. Something to keep in mind, by the way, make sure your inputs are all consistent in terms of time, right? So, for example, if R, risk-free rate, and sigma are quoted annually, which they usually are, then your T has to be a fraction of a year, right? Can be months or days or whatever. Okay, so then we're gonna start plugging and chugging. So D1 here is, literally, we're just literally substituting everything in here. Share price, strike price, R, sigma divided by 2. And our time step is 0.25. And this is all divided by sigma times the square root of T here. And so we get a value for D1 equal to 0.4302. So what does that mean? Well, we go here and we have some mu value, right? Mu equal to 0. This is a scaled, distribution. And it looks like D1 is sitting over here. Sorry. Yeah, this is D1. And it has a value of 0.4302. Excuse me. And so basically, when we take the cumulative normal probability, which is to say that what is the probability, right, of observing some values, we'll call them Z, like in the prior slide, that are less than or equal to the point at which we're evaluating it. In this case, we're evaluating it at D1. Well, we're just saying, look, draw a vertical line here. Give me the sum of all these probabilities. And so when I look up n of D1 here, or said differently, n of 0.4302, I get 67.65% probability, or sorry, 66.65% probability of observing a random draw of numbers leading all the way up to this, given the information about the share price, strike price, all that stuff. Okay. We do the same thing for D2. D2 is a little easier. We have a value for D1, 0.4302, and then we subtract the volatility times the square root of T, and we get a value of D2 of 0.1802. Again, we look up the value of, the cumulative probability of observing that number and everything below it, and we get a value of 0.5715. Okay. Now that we have our values for D1 and D2, we can plug them into the Black-Scholes-Merton equation here for the call option value, right? So the share price today times n of D1 minus the present value of the strike price, right? E negative RT times n of D2. And in our case, it's $13.70. So it's pretty easy. The hardest part, of course, is looking up the values for the cumulative density function for evaluated at D1 and D2. Now, a couple of things to take away from what's nice about the Black-Scholes-Merton model. We can show explicitly the central qualitative result, that is the option value, is monotonically increasing in volatility. So I'm going to go back a slide maybe two slides here, just to take a look at these values. Well, yeah, I'll get to that in a minute. So here's our parameters. No dividend yield here. For higher values of volatility, um, then the higher volatility means a fatter, right tail. Um, So here's the intuition. The intuition is that an options payoff is going to be asymmetric, right? Because just like a stock price, it's bounded below at zero and it's unbounded above. Okay. So higher volatility means fatter right tails. Well, I guess from your perspective this way. Fatter right tails, meaning, of course, the higher probability that they might be worth a lot. Um, the fatter left tail doesn't really hurt the option holder because the payoff is already zero at that point in time, right? It's an option, right? If the share price in this case is below 100, the strike price, well, the option's bounded at zero anyway. So there's not a lot of, so it doesn't really matter. Um, so essentially, we're saying here, vol is unambiguously good. That is, sigma volatility is unambiguously good for an option holder. Um, and and that's why the option market is fundamentally about volatility. It's a volatility market. Okay, it's a volatility market. Period. Um, you'll also notice a couple things that the higher the volatility, it shifts the whole curve up, but it's mostly, right at the money. That's where what we call the sensitivity to volatility, or vega, is the largest. And you can see the gap here, right? It's largest here, smaller out here to the right and left, right? It's much larger at the money. Volatility value is. Take a look at a work example here. Let's say we have a call option. Once we have the call option priced, we can just use put call parity from our prior discussions to reverse engineer, if you will, the value of the put option. And this, is essentially what the Black-Scholes model does. So from slide 20, if the last slide, two slides ago, I guess slide 19, as it were. The call option was worth $13.70, right? And so if you take the present value of the strike price of $95, this is equal to 92.65. You plug it into the equation, call present value of the strike minus the share price. Well, the put option is worth $6.35. So it's pretty straightforward there. Now, the parity holds exactly for European options on non-dividend paying stocks. For American puts, you might have early exercise, right? Which can add value. In that case, the Black-Scholes-Merton model is really just giving you a lower bound on the price, not the upper bound necessarily. Of course, the upper bound is always going to be the share price for call options, and the strike price for put options, which we've talked about before. Now, here's something that's interesting. The Black-Scholes-Merton model shows us that put values can actually fall below the intrinsic value because this is the early exercise problem. So for deep in the money puts, for European put options, you'll notice here that for prices, the option value lies below the intrinsic value that's shown here with the diamonds. I should probably change the colors here, and the reason for this is because I can't exercise European option early, right? And so if I can't exercise it early, then I can't lock in deep in the money profit. So in these cases, these options are worth quite a bit, but because it's a European style option, I can't get up to this implied value line, right? I can't get to this pricing curve. I'm stuck on this pricing curve because I cannot exercise early. Um, So for an American style option, this would never be an issue. An American style option, these lines would always be north are equal to the implied value line, right? The intrinsic line, because you can exercise it to earn that money. Um, um, so this is, again, why the Black-Scholes-Merton model is exact for European puts, but it only provides a lower bound, if you will, for American style puts. Now, I want to visit a topic here on something called implied volatility. What is implied volatility? Well, here's the thing. Real options trading in the market, they trade at observed prices. What's interesting is that all of the variables that go into pricing an option are visible, right? You can observe these things. The share price, the strike price, the risk-free rate, the time to maturity, and the dividend yield. You can observe all that. What you cannot observe is volatility. And you might say, sure we can. I see it all the time, right? I can take the prior price performance and calculate returns and the volatility of those returns. And what the giveaway there was, you have to go back and look at the history of the prices to infer or to calculate what the volatility of those prices is. Um, we cannot observe instantaneous volatility. We just can't, right? You can't have a clue for what it is right now. So what we do instead, since option prices themselves are observable, right? The call premium and the put premium, and all these other variables are observable. All we do is invert the Black-Scholes-Merton formula and infer what those prices say about the implied volatility. That is, we're going to solve for the sigma, the volatility that makes the Black-Scholes-Merton model equal to the market price that we observe. It's a numerical solution, right? And that's what we call implied volatility. So all the sigmas that we talk about when we talk about Black-Scholes-Merton models is implied volatility. And so in terms of the lingo of traders, um, when they talk about implied volatility, they're really talking about the prices of the options themselves, right? So, you can think of it as the lingua franca of options markets. That is, traders just talk about the options in terms of implied volatility almost exclusively, because everything's encoded in the prices, right? Now, what's interesting, an extension from the implied volatility is something called the VIX. The VIX, some of you may have heard of, sometimes called the fear index. What it actually is the implied volatility on the S&P 500 options contracts and the S&P 500 index option contracts. It's the implied volatility backed out of the prices on that particular index's options. So it's essentially the 30-day expectation, if you will, of S&P 500 volatility expressed as an annualized percentage, which in the long run, typically, somewhere in the 20-ish percentage range. Um, during calm times, it tends to be the low to mid-teens. And during crisis like global financial crisis or COVID, it surges. Sometimes, I remember during the crisis and then COVID, it surged over 80. Um, and the What's interesting about this is that a lot of traders tend to refer to the VIX as the fear index and could be a contrarian indicator, meaning, of course, when there's high volatility, it tends to coincide with market drawdowns, right? When the market's falling, as it were. And it also underlies a large complex of derivative products. So there's VIX futures, VIX options, or volatility exchange traded products here. But the VIX is also used as an index for other products. Um, and the underlying logic of using the VIX as a signal is that the option market does embed, the strength of the masses, right, in forecasting future risks in the market. All right. Along came Robert Merton, and updated the Black-Scholes formulas, and that's why we call it the Black-Scholes-Merton models. And oddly enough, these papers came out in the same year, in 19, I want to say 76. Could be out by a couple of years. And basically derived the same formulas, but then made them a bit more robust to account for, dividends and foreign exchange options and the like. So there's two important extensions here. For a stock paying continuous dividend yield Q, we can update the Black-Scholes models by essentially taking in that drag in the front part of the equation here by inserting the dividend yield Q as the discount to the share price. And you'll see it again here in the put price. We put it in on the other side over there. And then once we have these new values of, these are our new formulas for P and C, we also have to incorporate it in our evaluation of D1 by incorporating the drag R minus Q, as we've done before. Because, of course, the intuition here is that the dividend stream is paid out before maturity. And so it never reaches the option holder, so it's a drag, right? It discounts the share price. In terms of foreign exchange options, the setup looks relatively familiar. It's basically just substituting Q with the RF, right, which is the foreign risk-free rate. And so you'll see it again here, and it'll show up everywhere else the same way as well. So it's economically identical to the continuous dividend. Now, and then you use the same machinery. So it's thought of as exactly the same thing here. So if it's a dividend yield or a foreign currency, it still enters as a drag on the spot price. Okay. Last thing I want to leave you here is, how do we deal with American call options that have dividends? The stocks are paying dividends. Because remember, these are the ones we might want to exercise early. Of course, if it's not a dividend-paying stock, we never exercise it early. But for dividend-paying stocks, we have to account for that. So Fisher-Black's approximation for this was to handle it pragmatically here. Basically, he would price two European call options, one expiring at the natural maturity and one expiring just before the ex-dividend date, right? The date at which the dividend is going to be paid out. And just take the larger of the two, right? That's what the, Fisher-Black's approximation is here. There are more accurate methods, but basically it captures the key economics here. So it's relatively easy to implement, right? It's pretty crude, but effective here. So something to keep in mind. It's more of a ad hoc approach. All right, and we'll leave the lecture there on the Black-Scholes model. One thing I do want to leave with you, though, is our derivative software can also be modified just very slightly to utilize the Black-Scholes-Merton model here. So going back to the same software here, the only thing I have to change here is to change my drop-down menu. So in this example, this was the binomial model using a European style option, leaving everything the same. And when we calculated the price, it was $1.59. Now it's only 10 time steps, which is pretty good. But as I said, the binomial option needs to get to something like 30 plus time steps for it to be really accurate. Of course, if we take it to its infinite conclusion and use the Black-Scholes model, which is in the drop-down menu, and recalculate it, we'll get a more accurate price. In this case, $1.56, we'll call it. Now, here's something else that'll kind of tie this up for you. And I probably should have mentioned it at the beginning of the lecture. As the binomial model grows, right, as the number of time steps increases, right? So remember how we have two pricing paths and then maybe a couple more pricing paths, oops, and so on. As we get out to 30 time steps, which is when, as delta t approaches 30 or more time steps, You might say, well, that doesn't seem to be so numerically hard to do, but keep in mind, binomial means it goes two ways. So it means 2 to the power of 30, which is in the, I don't know, 2 to the power of 30, was that in the millions or billions in terms of possible prices, right? So it becomes rather cumbersome in terms of a tree, which is why this software only draws out 10 of those steps. It can't do any more. But you can imagine how this becomes infinitely larger, which is where the Black-Scholes equations take over. Let's see, one other thing I wanted to leave you with is I can't remember. Maybe we'll come back to this next time. Oops, and 0, calculate. Hold on. There we go. So what is nice about this software is it can also calculate for you the implied volatility. So I don't know if you noticed what I just did there, but I cleared out everything here. You have to have something in for volatility. You can use any number that's positive. If you click this implied volatility button, here's what it's saying. On this particular option, with a stock price of 20, and a risk rate of 4.5%, a life of 1 year, and a strike price of $21, this call option, I've got the radio button clicked here. If I click this implied volatility button, if it's priced at $5, right? If the call premium is $5 and I enter that here, when I hit calculate, it calculates the implied volatility. What this says is if this stock or if this call option is trading for $5, that means the implied volatility is very high, 64%. So it basically gives us a price signal. It says, wow, this is very, very expensive call option, right? If the underlying realized volatility is lower, right, this could signal an expensive call option. Okay, we'll come back to this concept in the next lecture. We'll leave it there. Next time we come back, we'll extend this to other types of options. So, indices, currencies, and futures, employee stock options, and so on. We'll see you then.